Good evening, guys. Welcome back to Not So Late Show. So as you guys know, we are slowly coming to the end of 2021, and we still have our last episode, or I would say installment of Thematic Transcripts, which will be touching on cloud-related companies. So we guess that it would be a great way to kickstart the preparations by talking about some cloud-related businesses. And today, surprisingly, we have a REIT on our hand, right? So this REIT is also going to be connected or correlated to cloud businesses. It's a data center REIT, and the name would be Keppel DC REIT. So of course, share price has been coming down for quite a lot, and of course, I believe most of us are asking, is it time to buy right now, right? So let's dive straight into it. As always, before we go through our sharing, just a quick disclaimer: please do not take it as a decision to buy, sell, or hold any investments or companies that we might be mentioning in this sharing. Please do your due diligence and do further analysis before you actually make your investment decision. But we hope that what we share right here today is a good pointer to help you make your decision or to study which segment further. So I'll pass to Chun Bing to kickstart off what is a data center REIT.
Yep. So I think today we're going to share about a REIT that is located in Singapore. I mean, as in listed in Singapore Exchange. But then this is technically a pure play data center REITs where they are managing data center across multiple countries. So you can see, although the focus you can see coming from Singapore and Malaysia and also Australia, they also have a few portfolio or asset under their management, which is in Europe. So the total AUM or assets under management is worth 3.1 billion across 8 countries, right? And then you can see this basically the structure that set up this Keppel DC REITs is actually coming from this Keppel TNT, Keppel Telecommunication and Transportation, and they own about 20.6%, while the institutional and also public investor own about 79.1% of these REITs. And of course, as usual, this REIT will be managed by the managers. It's also linked to their sponsor, which is Keppel TNT, and also have some of it actually owned by Keppel Capitals, so which can give them some of the access or leverage when they wanted to do some of the financing activities. And of course, the rest, it will be the ownership of the properties, and then they will be having the facility managers to do all the management, right? So this is basically the different data centers across different countries. Majority of the data centers actually located in Singapore are having a very high occupancy rates. The one that might actually spark your interest or give a red flag is the one that actually located in Malaysia, which is this Basis Bay data center. But it shouldn't be causing you a lot of concern if you look into the actual contribution of the entire asset. The Malaysia one only contribute about 0.8% towards their entire portfolio, so shouldn't be a big concern. But of course, they're working very hard to actually try to increase the occupancy rates. And then this is the remaining data centers that's coming from Europe. All the occupancy rates is quite high. Majority of it is actually at 100%. And of course, some of it, they are having the land lease title that might be expiring soon. If you go back to the previous slide, some of it, they already working hard to actually try to renew the land lease title. So if you wanted to look into the breakdown of the portfolio, as of 31st of December 2020, you can see majority of the data center is actually, if you go by the lease type, is a data center type called co-location. So what does it mean is basically some of the corporates, they wanted to have their data centers resided in some place. And then Keppel DC REIT have the facility for them to put in their private servers, so they will be able to actually set up all their data center over there. And then what they need to do is just need to give them the rental, and then they will be able to enjoy the facilities. So in short, co-location is more towards multi-tenanted, multiples enterprise actually contributed to the entire locations, and then the rest is the one that typically owned by a single customer. So it can be further differentiated between fully fitted and also shell and core. So shell and core by the name means they just prepare the locations, meaning they set up the uh, exterior part of the buildings, while the interior part of the things, meaning all the servers, is not set up. So those is actually categorized under shell and core. They just build the core and then let the tenant come inside and build the facility themselves. Another part is actually fully fitted, meaning they take one step further to also cover some of the interior part of the things. While if you look into the breakdown by geographicals, of course, Singapore contributed the most, followed by Australia and also Europe. So the one that actually didn't perform very well is the one coming from Cyberjaya Malaysia, which only contribute about 0.8% if you talk about the AUM. And then if the attributables are lettable areas, if you see it that way, there may be slight difference. So Singapore maybe is not the one that actually occupying the most areas, but then they are actually bringing the most rental income, right? So move forward into the breakdown by the industry. You can see most of the guys actually internet enterprise. Some of it is actually IT services and also telecom. So it didn't really differ much because all these guys is actually trying to find a place they are able to set up their servers securely and then managed by some professionals. So this is just a breakdown by industry. And these are some of the key updates from Keppel DC REITs as of 30th of June 2021. So they has been proactively working very hard to renew some of the rentals with a few clients that are going to expire in these 2 years. So if you see the chart at the bottom, if you zoom into the portfolio by rental income, they will be about a quarter of their portfolio going to expire soon. So they has been working very hard to try to renew their contract and then try to extend it, let's say, to another 5 to 6 years. Other than that, one of the things that is going to complete is the data center resided in Sydney. This development cost is actually about 26 million. If you talk about Singapore dollar, will be 26.6 millions dollars. And although most of the activity they're trying to do is to actually keep their contract active and also trying to renew the contract. Part of the activity they have done by them is also trying to do some divestment. So this is something they have done in this ISIC data center in Brisbane. So they actually grant them the option for them to buy back. So this is to ensure all their portfolio is at the optimal returns. And of course, if in summary, majority of the portfolio's occupancy is at 98%, and their WALEs is actually about 6.5 years. So it's very healthy if you see it from a REIT perspective. And of course, this pretty much sums up everything about Keppel DC REITs. It's a very straightforward REITs where they put their focus in setting up the facility for data center, and their share price has been performing for the past few years, but recently has been dropping. So maybe Jupan can take us through on some of the reason why the share price not performing recently.
Okay, sure. Thank you very much, Bing. So basically, we will go straight into the financials first. But before that, just a shout out to what we are currently offering for those who actually want to learn more and also be a part of our family. So we do have the Kaya Plus Premium Club where we give out a subscription-based service. So we will have a private Facebook group where the discussion can actually continue on from there. Apart from the YouTube videos that you might be watching right now. There's also private videos and private kind of sharings that we do on a monthly basis to the club members. We also will craft, analyze companies, and then make them into a premium article for the premium members to actually enjoy and to read up and to actually, continue the discussion at the Facebook private group. And remember, we talked about in the earlier part of the video that we will be doing our last installment for thematic transcripts. So we have actually talked about EVs, we talk about semiconductor stocks, we talk about e-commerce, and the upcoming one will be in the month of November, where we'll talk about companies in the cloud-based business. So just to give you guys a snapshot, this will be basically the, bring you guys through the cloud businesses, the cloud hosting companies, the SaaS companies, the security companies, and also the data centers. And what we are sharing here today for Keppel DC REIT is just the introductory part of it. There will be much more detailed analysis and breakdown on Keppel DC REIT in this installment of the Thematic Transcripts. So here you have it. Basically, this is what we do. And there are also other services that we do provide for Kaya Plus Premium Club members. Right, let's go straight to the top line and bottom line of Keppel DC REIT. As you can see, straightforward, it is in uptrend, right? Growing, I would say, exciting kind of new REIT that has been growing their AUM and has been buying up, investing up in much growing their investment portfolio, right? So the rental income generated will actually show quite clearly in their financial statements. And of course, there's also the ever-growing net income as well. You can actually see that for fiscal year 2018, there's a sudden increase in your net income due to the fair value gains from the properties that they actually have completed. So you take that off, actually, it is actually still a very stable and uptrend kind of performance for the past 5 years. Next, straightforward also, you can see if the REIT is actually growing their top line and bottom line, usually for rental kind of business, the operating cash flow or the cash flow from operating businesses also will tag along as well. But of course, this is a REIT that we talk about is still growing quite aggressively. That's why you can see that there's also huge amount of cash from investing activities or the cash outflow from there. Basically, this is mainly for the upkeeping of their existing investment portfolios, and also the REIT is also growing, right? We talk about it. So they will be putting out money to increase their AUM or increase their investment portfolios. Hence, you can see that there is a larger outflow of cash from investing activities. But at the end of the day, it's for growth. If the so-called strategy and the purchase price is right, you can actually see the accretive kind of returns provided by the REIT. So here's just a snapshot of the latest balance sheet. Basically, you can see that investment properties has been growing, and then the property under development also have some uptick also as well. And at the end of the day, if they actually play their game right in terms of balancing the leverage and also the gearing ratio, and try not to overdo on the equity raising part, the units in issue does not dilute their upcoming earnings too much, then you can actually see some sort of accretive returns or accretive effect from the net asset per unit point of view, and also the distribution per unit point of view. Now next, we look more into the capital or the so-called debt maturity profile. So you can see that their debt is quite, I would say, evenly split out for the upcoming 6 years. The one that you can actually see in 2021 with they've actually give some comments that they do have the commitments to refinance the loan, so that for upcoming 2021 shouldn't pose any difficulties and issues to actually refinance the loan. One good or exciting or I would say very attractive ratio that Keppel DC REIT has is it's a high interest coverage ratio. You can see right here, which is 12.9 times. So basically, whatever they earn, the net operating income from their operations can actually pay or finance their interest by 13 times. So meaning to say that if there is change in interest rates in the coming quarters, coming years, when the economy slowly rebound, this REIT would be relatively safe from the change in interest rates. And also their borrowings on fixed rate is more than 50%, so you won't actually see increase in terms of the financial expense coming in so soon, because of the 67% of their borrowings are on fixed rates. And if you look at the ROA and ROE, it is slowly on an uptrend, save for what happened in 2018 due to the net fair value gain of their properties. But other than that, I would say straightforward REIT in a very niche growing segment. Hence, you see the financials are quite healthy and actually quite attractive as well. And here you have it. The interest coverage ratio has been on the uptrend as well. And the dividend per share, or we say the distribution per share, is also on a gradual uptrend as well. So everything of it, if you look at it briefly, it really does translate to a good REIT kind of return and good track record. And then looking back at the past few years, the distribution and the yield, it has been trading at around, I would say 2.7% to as high as 4%. I think recently, due to the share price correction, the valuation actually is giving the trailing 4% dividend yield. So of course, the question is whether you are actually tempted to buy. So you can see it here, share price have actually came down from the top peak at $3 per unit, and based on the recent or the current close or the trading, which is around $2 and around 38 cents. So giving you a trailing yield of 3% or 3.6%, and the PE is around 22. So I think before we actually consider whether the valuation is good enough or not, I think it's more important to look at the PE band as well, which you can see is also coming down. And to tackle the comparisons between Keppel DC REIT and the other REITs that have DC exposure. So you have the Ascendas, you also have Mapletree Industrial Trust. So in terms of PB ratios, it's still the highest, around 2.12 times higher, relatively higher than Ascendas and also Mapletree. And of course, the distribution yield is also slightly on the lower side, so 3.79%, but close to 4, right? But Ascendas and Mapletree might be giving you a trailing of 4.8 and also 4.4. So maybe some of you might be still wanting to pay a premium to a pure DC REIT like Keppel, but I think things have slightly changed for the past few months after they actually look or trying to enter into a kind of investment arrangement with M1, right? So I'll pass it to Chun Bing if he actually what he actually feels and what he actually thinks of this arrangement.
I think during the announcement about the strategic JV with M1, they also announced another thing, which is something that they put inside here under this expansion of investment mandate. What does it mean is they wanted to actually expand themselves from a pure data centers REITs to something else, meaning they can invest in retail related areas, and then no longer a pure play data centers. So maybe people are having some bad impression, or doubts against them. I pay a premium because I thought data center will be giving me a very good returns in the coming years. But now you are saying, yeah, I'm good at data center, but at the same time, I try to go into other area as well. So make them no different from the other REITs. So this is some of the reason why the share price tanked a little bit. But of course, when we zoom into the investment between them and also M1 for this network asset, basically how they work is they will form a special purpose vehicles or SPV called NetCo, where Keppel themselves will actually inject 88.7 million into it, while M1 will also actually put in some of the money, which is 1 million worth of ordinary share into NetCo. So why they put in all this money? And then they will also, I mean, NetCo themselves, the one in between, will try to get some loans, or it's highlighted in the green color called external borrowing. So whole thing will actually able to build up to 580 millions so that they can actually buy the asset from M1. And subsequently, NetCo will be the company that manage the whole thing. So whether this is a good move or bad move, basically the next slide will give you a better view.
Yeah, so
Right.
I think basically to sum it up, M1 wants to inject their asset intensive portion into NetCo, and Keppel DC REIT will be one of the parties who actually subscribe to the NetCo bonds, which is at 88.7 million Sing dollar, and they get a preference shares of 1 million. So what is the benefit of actually subscribing to these 88.7 million SGD bonds for 15 years?
Yeah, so the key one is basically they buy into some asset, and then this asset can generate some sort of return every single year because they pump in the 88.7 million. So it's forecasted they will get about 11 millions a year. So this is already including the interest income, right? So from a capital perspective, beside having a strategic investment, I mean strategic partnership with M1, this is the only thing they get. But from M1 perspective, maybe it's a very strategic play. So they are able to divert out the 580 million worth of asset to somebody else to manage it. So from their P&L perspective, maybe it's good. They make their asset become very light. But for Keppel, nothing much beside this so-called fixed income. But of course, if you see it from a dividend yield point of view, maybe it will pump up a little bit, but
Yep.
it didn't really have any synergy other than that lah.
Yeah. So it's, I would say, just a 15 years kind of benefit where you actually get to enjoy the principal plus the interest paid back by being the NetCo bond subscriber. And after that, and we still don't know how the preference share of NetCo are going to come to play, how it will actually make Keppel DC REIT better. But from a monetary return point of view, Keppel DC REIT holders will just be looking at this 15 years interest repayment for being the subscriber of the bonds. The one that actually is the ultimate beneficiary would be actually M1 getting the 580 million Sing dollar cash by actually transferring their assets to NetCo. Right. I think there's also some near-term headwinds for DC REITs as well, where Singapore's actually put temporary pause on new data centers, and that actually means that there won't be that much Singapore DC properties for DC REITs like Keppel to actually increase their investment property portfolio, but they can actually look at elsewhere lah, right? So this is actually how they want to, try to overcome these kind of temporary kind of roadblock obstacles. So I guess that's about it. Good financials, good numbers, but I would say facing some of near-term challenges or obstacles. But is this kind of DC REIT your cup of tea, JuMeng?
Of course, if they are mainly focusing in data center, Evolve actually buy at premium. I mean, in my personal opinion, compared to the other REITs, especially for example, especially like office REIT, it might actually having some downside after pandemic. People might not going back to office, but for data center, it definitely is a need for the coming years, right? So other than that, the recent so-called movement, I think is the key reason why contribute back. I mean, reflected to their share price. Is due to all these linkage to data center become further and further. I mean, last time you will link Keppel to data center straight away, but now they're trying to tell you, I'm going to diversify my portfolio into retails, into office, and so on. And I did a so-called strategic relationship with M1, but I get nothing beside a 15 years kind of fixed returns. So all this make maybe the shareholders or the investors slightly disappointed. That's why it causing I would say after steadily at about 2.5, so now they are about 2.4 or even 2.3. So maybe it's an opportunity to go in, but it's still traded at a premium if compared to the other REITs in Singapore.
Yeah. So I think they asked you a lot of factors and also items that we don't have the time nor the so-called effort to squeeze it in this episode, but definitely what we will definitely dive deeper in the upcoming thematic transcript. So let us know in the comments or let us know that if you're interested to join us, do actually sign up for our premium club. You also get access to the EV, semiconductor, and also e-commerce thematic sharings that we have for free when you sign up to be a KayaPlus Premium Club. So that's it for today. I hope that it has been a good and brief kind of introduction on what actually transpires, what made Keppel DC REIT share price came down, and whether it's still a good company or not financially, and also their prospects. But of course, let us know also what other companies, REITs that you want us to analyze in this similar fashion of our Not Ordinary show. So we'll see you in the next episode next week. Take care. Bye bye.